Hello everyone, and welcome back to the Marine Money webinar series. I'm your host, John Chair, and I'm glad to be hosting today's webinar as it is an extremely hot topic of the containership market. With shares more than doubling for some containership owners since August, there seems like there is plenty of opportunity for owners, investors, and lenders to make some money over the next quarter. However, don't take my word for it. Today, we have a couple of industry experts to take us through the nuances of this market and what we can expect to see in the coming weeks and months. Today's panelists are James Buck, who is the CEO of Songa Containers. James has over 20 years of experience in the container sector, a career spanning both Europe and Europe to Asia. Initially entering the market on the liner side with Maersk, he went on to hold senior positions with international brokering houses Brennmar and Seascope. Brennmar, Seascope, and Maersk Brokers. More recently, James was employed with privately owned container shipping company Lomar, headquartered in London, before a spell with a Canadian stock-listed company, container ship owner Seaspan. James is joined by Evangelos Chatzis, who is the CFO and Secretary of the Danaos Corporation. Evangelos has been with the company since 2005 and has had over 24 years of experience in the industry. His tenure at the company has had him do everything from being actively engaged in the company's IPO to leading all financing functions at the company. Finally, moderating the session, we have the one and only Randy Giveans. This man needs little introduction as he is a bit of a man about the webinar circuit. For those who don't know Randy, shame on you. He is the senior analyst and group head of Energy Maritime Shipping Equity Research Group and senior vice president at Jefferies. So as you can see, we have a team with a deep experience among them. So it's going to be a doozy. Before I hand it over to them, I just want to do a quick kind of tech review. For this webinar, the audience will be muted to ensure audio quality control. During this webinar, you'll have the opportunity to ask questions to the panelists. This is the whole reason we do this live, so please take advantage of this and ask questions to the panelists. To ask questions, you simply enter your question into the text box at the bottom of the control panel where it says question, like shown on my screen. I will receive them and at the end of the session, ask them on your behalf. These questions will be anonymous. Finally, if you want to collapse your menu to see the fantastic talent we have today, simply click on the orange/red box with the arrow in it, and it should collapse the menu. Now, with all of that said, I'm going to hand it over to Randy to kick this off.
All right. Well, hey, thanks so much, John. Thanks, Marine Money, for hosting this event. Evangelos, James, certainly, as John said, a hot market right now, so should be a rousing discussion on container ships, which obviously have not gotten much love here in recent years. So good to see the market strengthening. Now, with that, throughout the year, we've heard of V-shaped recovery. Everything's going to be a V-shaped recovery. Second quarter, third quarter might be bad, but the fourth quarter will be back to where it was. That has not been the case for the vast majority of shipping sectors or companies, right? However, we have seen that in container shipping, right? The container sector, time charter rates are not only back to levels at the beginning of the year, they're at multi-year highs. So if you can kind of just open us up with what has driven that, what has caused this massive V-shaped recovery, maybe what caused the weakness in May, June, July, and what caused the incredible strength here in the last 3 months. Evangelos, start us off.
Yeah, thanks, Randy, and thanks to Marine Money for hosting this. When we went into the COVID era, whereby for the first few months Asia was shut down, and then you had Europe and the US shut down with all the lockdowns and everything, we saw a big contraction in volumes, right? And for the first time, I think ever, the liner companies reacted to it very good. They withdrew capacity from the market, they canceled sailings, so they managed to keep box rates at healthy levels, and in some instances we even saw box rates go up. That of course had the effect of plummeting charter rates, because ships of charter owners like ourselves were being redelivered, and there was a big drop of up to 50% in charter rates. What has recently happened, and this is something we saw from August onwards, we've seen volumes go up significantly, and there are a number of reasons for that. Consumption in actual terms has gone up in the United States, for example. We have figures that have come out now that demonstrate real consumption having gone up. You have restocking because, you know, during the COVID period, due to the low volumes, stocks were starting to be depleted. You also have early ordering for the holiday season because people are afraid they would be left without stock if a big second or third wave comes along and disrupts again the chain. So the combined effect of all that is that volumes have gone through the roof, container ships are full, and all the container ships that had been idled have come back into service. And at this point, there aren't enough ships to service what's happening. So you have a big increase in charter rates. We've seen charter rates go up even by 100% in some instances. And that's where we are today. Now, to your point on whether this is sustainable going forward, our view is that yes, demand growth would continue to be there. We've seen IMF forecast 5% growth for 2021 coming from the lows of 2020, of course, but demand growth will continue to be there. And what's most important is that supply is very favorable for containers, and it will continue to be so for the next 2 to 3 years. There hasn't been any ordering for a prolonged period of time. We don't see how people are going to place orders for new buildings anytime soon. There are technological obsolescence concerns, point number one. New buildings do not make sense as an investment at this point. They're too expensive, i.e. second-hand prices have not yet caught up to justify investing in a new building. So, and the order book at this point is at an all-time low. It's something like below 8% of the existing fleet. So this is a recipe for a very good container market in the medium term, i.e. for the next 3 years at least, I would say. Now, over the next months, you may see some sort of easing or softening, if you will, because it's low season and everything else. No one knows how COVID over the next 6 months will affect trade flows, but what we see is a trend line that goes up, right? And this is why we believe the container business has very good days ahead.
Okay. Yeah, James, I'll turn this one to you, kind of following up on Evangelos' comments there. The container ship order book, right, arguably at an all-time low. So do you think there'll be an ordering spree? Why or why not? And if you do think that, when do you think that happens?
There should be, shouldn't there? First of all, thank you, and yeah, good to be here. Thanks for the invite from Marine Money. There should be, shouldn't there? I mean, new building prices are probably at their lowest point they can be at the moment, in spite of Evangelos' comments. But in terms of steel, labour, yard consolidation, they're as low as they can be. But I'm still not convinced the situation is going to change anytime soon. COVID had a huge impact globally. It stifled demand, put a lot of projects that were moving forward on the shelf. We're starting to hear some of those coming back now, but they're all on the larger side of things, the upper echelons of the market. The larger issue here, as Evangelos just touched upon there, is around environmental regulations and targets, and they are the stumbling point at the moment, which is ironic because in order to meet certain regulations, 2030, 2050 targets, we need to be ordering new, improved, more economical ships now. But there's a paralysis over the propulsion system. I listened to a very good webinar from DMVGL last week outlining the options available to us. I think at the moment LNG is probably the best current alternative. And as we've seen from the maiden sailing of the CMA CGM Jacques Sardet, very good for the larger ships. You get the economies of scale. The ships are far more expensive, but you can pay that down and you get the economical benefits as well. But in our sector, with Songa looking Panamax and below in the smaller ships, the pricing we've seen recently, say on a 2700, I saw a new building priced at 30 million, and the equivalent DMV dual fuel LNG ship priced at 40 million. So you're talking a 30% markup there, which you've got to write down before you're back on parity with the standard fuel vessel. Also the trading pattern for feeders as well. They're moving in and out of small ports. LNG requires infrastructure, it requires storage, and you just don't necessarily see that in some of these smaller ports the ships are trading into and out of. It's still part of the jigsaw, don't get me wrong. I think LNG is part of the jigsaw. Songa ourselves, we went down the scrubber route, and while that's in the short term, it's not proved so profitable. It's a longer term play, a longer term environmental play, asset flexibility play. And they'll all be parts of the puzzle. But what we really need here is more partnership between the charterers and the owners, which we haven't seen in recent years. Longer periods offered to work together on projects in order to pay for this more expensive technology going forward. And then maybe we'll start to see a few more new buildings coming forward.
Yeah, no, that makes sense. And on the LNG side, sure, it might be economical for the 12, 15, 18,000 TEUs that are just going back and forth, you know, China, US West Coast, China, Europe. But for some of the smaller regional, intermediate, especially the feeders, right, it'd be hard to put that price tag on there. Evangelos, back to you. You know, according to the CEO of Ocean Network Express, ONE, I'm going to quote him here. The ships are 100% full. The containers are 100% full. You can't get a container built. You can't pick up a ship from the spot market. The whole container shipping cycle is absolutely full pulse. Do you agree with this statement? You know, have all the blank sailings and voyage cancellations been reversed? Is the idle container ship fleet effectively 0% now? And then I guess, how are liners dealing with this shortage of both containers and container ships?
Yeah, I also read that piece, and you know, it sums it up, right? Container market is red hot right now. There's no doubt, and you know, I concur with all that was said. Indeed, we are, you know, everyone is operating at full capacity, and people are looking for ships which are not available in certain instances, and that is why charter rates have gone up. What we have not yet seen is, you know, you can fix a ship today for 2 or 3 years, right? Because you have liner companies that are willing to pay good money to lock in the vessel because they need to use it for their services. We haven't yet seen longer periods come into play, which one would reasonably expect, given that, you know, capacity is strained. You know, I think that in general, no one is going to make any long-term, quote-unquote, decisions in the, you know, amidst a pandemic. I think people are trying to, you know, liners are making a lot of money right now. They can afford easily to pay the charter rates they have to pay. So they're basically trying to secure tonnage for 1, 2, or 3 years at this point to ensure that they have the tools in their hands to run their business. And that's where we are. And in terms of new buildings, and coming back to James's point on the technology, I'd like to add that obviously, you know, currently the only technology available is LNG propulsion. I don't think the industry is convinced that this is the optimal way to go forward. Obviously it's more expensive, and you get a 20% reduction in CO2 emissions, but you don't get rid of all the other greenhouse gases and the rest. So there is still some way to go until we settle on until the industry settles to the technology that people believe is going to really work, and that is only when we're going to see people wanting to place more orders. In the interim, as I said before, we're looking forward to a very strong charter market because of the capacity constraints.
Sure. And I covered Danaos pretty closely. You certainly had some smaller, intermediate and smaller vessels coming up for renewals or that were open as of a few months ago. Are all those ships employed now? Have you been able to lock in some 1 or even 2-year time charters, or are all the recent employment fixtures just 3 to 6 months?
No, we're locking in periods of 1 year. We fixed a ship that came off charter that was in the mid-teens and we chartered the ship for $30,000 a day, just to give you some sort of sense. And
for a year, or is that a 3-month charter?
For a year. For a year, yeah.
Oh wow. Okay.
For a year.
Great.
And there are also deals that you can get out, you know, up to 2 or 3 years. The other thing which is interesting is that second-hand values for decent vessels, for good vessels, have not, you know, are still very appealing when you relate them to the earnings capacity and the outlook, right? So I believe it's time to invest, and there are good returns to be made. And we're certainly, we as a company, we're certainly investing in the business. We've made acquisitions during the year, and I think we will continue to do a bit more.
And would that all be via secondhand acquisitions?
Yes, secondhand acquisitions.
Got it. Okay. James, turning to you, some would argue that the rate strength that we've seen is purely just American, European retailers near sourcing, right? Increasing their inventory domestically in case there is a second or a third wave of COVID in the coming months or quarters. So is the current strength really just pulling forward a lot of demand from, let's call it 4Q20 throughout 2021, or, which obviously would result in a pretty sharp pullback in rates? Or do you see this as kind of the new normal and kind of a new level of inventory building and sustainable rate levels?
I think in terms of near sourcing, do you mean near shoring, or I don't think near shoring is maybe something that's going to come in the future. I don't think it's there at the moment. I mean, I've seen in the last quarter, I think the US trade deficit with Asia has risen, so they're still importing a lot from Asia. Yeah, as I said, maybe in the medium to longer term, this will change. The demand at the moment is now relating to consumer purchasing habits. I think less service-related items are being purchased at the moment during the pandemic, moving to more luxury goods, more consumer retail goods. And it's not necessarily 2021. I think there's actually a restocking going on from second quarter of this year, where there are very low inventory levels. A lot of the shops sold out as a result of that, and we're seeing a restocking at the moment from the second quarter of this year, leading through the end of this year now. In terms of whether this market's sustainable, I mean, you could be forgiven for being pessimistic from having been in the container industry for as long as myself and Evangelos. I mean, the current run looks like being prolonged through first quarter 2021. By 2021, there's going to be a GDP rebalancing. We mentioned 5%. It looks like global trade growth will be rebounding to about 8%, with container trade accounting for half of that. But even with normalized demand, and you would expect maybe things to drop off, I'd sort of concentrate and focus in on the longer term supply side story. As Evangelos mentioned, we've got a order book at the moment currently at around 8% or slightly below. In terms of the mix there, that's a lot of larger vessels, a lot of liner owned tonnage coming out of the yards. There's no tramp owner orders at the yards between 3,000 and 9,000 TEU, even 15,000 TEU at the moment. So that's a big gap, and a lot of these ships now, I think the 5,000 to 10,000 TEU sector, 30% of that sector is coming up to 15 years old now next year. Sub-Panamax, it's skewed further. You've actually got a contracting in net supply from 2021 onwards. As we said, there's a paralysis now over Newbuildings. The tonnage isn't being replaced, and yet you're also seeing, as you sort of hinted at, this nearshoring, which I think will come eventually, and a redesigning of supply chain networks will have an effect and actually need more feeder ships going forward. So it could be a sort of double dip there, if you like.
Okay, I have a few more questions, but I'll just ask one more before we kind of turn it over to those on the line. We certainly want to make this an interactive Q&A. So last question for me here, and maybe most importantly to investors, have these record container rates you know, as Evangelos has already said, that they've boosted his kind of term business, right? The 1 to 2 year charters. James, have you seen the same? And also, Evangelos, to you, how has Danaos kind of capitalized on this current strength? Have you been selling maybe some vessels? Are you acquiring some vessels? Or are you just solely kind of locking in as many 1 to 2 year time charters at these strong rate levels to offset some of the weaker charters that you had to sign maybe last year?
We have, obviously, we're not sellers of ships at this point. We are investing in the business. As I said, we've already acquired ships in the 9,000 TEU range, and I think we're going to be doing some more. So that's one thing. And we're also, you know, due to the high contract coverage that we have certain ships that are opening up, and obviously they're getting much higher charter rates than previously. And this is something that will continue for Danaos through the end of Q1 of next year. So as we gradually have vessels being, vessels periods expiring, charter periods, we're going to be capitalizing on that. And, you know, other than that, we are enjoying the good market. And the other thing is, you know, mentioning contract coverage, we didn't discuss this at all. Liner companies are making huge profits right now, right? And that's a combination of strong box rates, of course, but also low fuel prices, lower interest rates. And, you know, we feel very well with the contract coverage that we have and with the quality of our charters. Counterparty risk is something that is not at all a concern at this point, which is also very important. You have contracts with people, you want them to, you know, you want to feel the comfort that all of these will be performed. And although at the beginning of the COVID crisis, people were very thoughtful of how the liner companies would fare, I think all of these people are now on the entirely other side of the equation. So,
yeah, that's certainly true. In the second quarter, I fielded a lot of questions around the strength of CMA CGM and Hapag-Lloyd and Maersk and other kind of liners, because if they are weak, you know, obviously those contracts with them are a little more and more risky. But obviously, the stronger that their performance is, the stronger their balance sheets, the better it is for the owners who are leasing vessels to them. James, what about you? How's Songa kind of taking advantage of this market?
I mean, the previous years, yeah, from a feeder operator or a sub-Panamax owner, the previous years have been very tough. We also made a play on scrubbers, went through a whole CapEx program relating to scrubbers. Now, in the short term, yeah, that's yeah, with the fuel spread at the moment, it's been it's a tough scenario. But we'll work through it. It's a longer term play, as I said. And at the moment, in terms of the shape of our business, capitalizing on the current market, we're getting longer relative periods. The smaller ships, which were fixing 3 to 6 months, are now fixing 12 months. Yeah, the larger ships like Evangelos had is maybe going up to 3 years now, but we're also having relatively longer periods. Much higher rates as well, you know, doubling the rates as we're refixing the ships, which are gradually coming back and being renegotiated. And we're enjoying a period of operating, improving our bottom line and margin, and increasing the company's overall earnings.
Great. Good. Well, I have a few more questions, but I'll turn it over to John if he can open it up to those on the phone lines.
Fantastic. Thank you, Randy. Thank you, Evangelos. Thank you, James. So we have questions that have come in, but obviously, audience, feel free to continue to drop in more questions. But the one to kick it off would be, do you think ship prices reflect the strong rates?
I alluded to that before. You know, there are opportunities out there to acquire second-hand tonnage anywhere between 10 to 15 years old, let's say, ballpark, at prices on which you can make very good returns with the current earnings capability of these assets. Question is, obviously, how long you think this good market is going to last for. But, you know, if you make a very good chunk of your investment back, if you know, manage to earn it back over a year with a charter or whatever, it may make very good sense.
Okay. Randy, is it time for IPOs for container companies?
That's a good question. You know, there certainly has been some bids for some of the container ship owners that we've seen. You know, we've been pretty bullish on Danaos for quite a while now, and it's close to $10, right? So there's certainly people who are seeing the strength in the container ship market, and you know, it's not just a 1 or 2 month, 1 or 2 quarter strength, right? What you're seeing now, especially with the time charter market, the 1 to 2 year market ramping up so dramatically, these earnings are going to improve, you know, 2021 and possibly even flow into 2022. So it's not just a transient strength that you see maybe when Cape sizes rally or when VLCCs rally and you get a couple good cargoes out of it. Now you're seeing a couple good quarters, if not years, from the current strength, and that's what Evangelos was alluding to. So in terms of the IPO, I think you still need some scale, some size, but the market is certainly heating up towards the container ship business.
Okay, and so we had a question come in there about seasonal strength. So what you're saying is that this is not a seasonal blip that we're seeing.
Correct. Yeah, in our view, it is, and I'll let the pros here, Songa and Danaos, kind of give their 2 cents as well. But yes, I do think rates might soften, you know, or will soften, right, in maybe December, January, after we get through this huge inventory run up. But they're not going back to levels we saw in the second quarter, right? And secondly, as I mentioned, you know, the time charters that these owners are able to secure now are lasting 6, 12, 18 months, right? So 2 years, right? So it's not just a 1 or 2 month strength that you'll see in terms of revenue and net income. But I'll let Evangelos and James add their commentary as well.
I'd agree with Randy there. I mean, I'd say in terms of seasonality, I think we might see a plateauing towards the end of the year. We're still going to have this huge container shortage, which, according to the leasing companies, is going to last until at least Chinese New Year, or even slightly after that. I mean, the factories are at full capacity now, but they're playing catch up from low ordering of containers in 2019 and earlier this year. So that's going to constrict things, and you're actually almost getting box space being auctioned off. I even heard a story today that one of the liners is taking orders from shippers in reefer containers and charging a premium for shipping regular dry goods in reefer containers with a repositioning bonus at the end in order to get the reefers back into position afterwards. So I think with stories like that, it's going to, you know, it keeps the momentum going. It allows owners to have a bit more time in the sun to book some of these good rates and strong periods in. The larger ships on longer periods, us on 12 months, possibly even get up to 18 months, 2 years now on 2800s in the market. So I think there's still some more time to go.
Wow, that's incredible. So we had a couple questions coming around the order book. This one's a bit long, so bear with me. There are no mid-sized ships on order. The 7,000 to 8,500 TEU segment is aging. Will we see a new building surge of neopanmax vessels in the next few years, replacing the older 7,000 to 8,500 TEU vessels? Vessels that can trade north and south as well as east and west, and can transit the Panama Canal.
Well, you know, a lot was said about technology and environmental issues and propulsion solutions and all that. But let me lay it out for you, probably in a very simple example. To build an 8 or a 9,000 TEU container ship today, you need to spend 80 million roundabout, right? Maybe it's 90 or 95 or even 100 if you do it LNG propulsion and all these things, right? Now, the earnings and the equivalent 10-year-old second-hand ship to be acquired today is going to cost you something like 30, 31, 32 million, right? So the earnings, first of all, the new building is going to hit the water in a couple of years. And even so, the earnings that the new building can get, maybe they're a bit better than the second hand because it's more fuel efficient and all these things, but they're not going to be significantly higher than what these vessels are commanding in the market today. There's no way this investment makes sense. So, and as James said before, you know, new building prices are, you know, as low as they can go, right? It's not that they're inflated. It's just that, you know, second-hand prices have not yet gone up to justify investing in a new building. So what's probably going to happen over the course of the next in the medium term, let's say 1 to 3 years, you're going to see the market strengthening more and more. Asset prices are going up. And at some point, people are going to say, okay, well, now it may make sense for me to build a new ship. And maybe you have new propulsion technologies, maybe you have ammonia and all these other things that are being tested right now, and there's a lot of R&D going into this. Maybe then it's going to start making sense. But I don't think that at this point anyone is going to place an order.
Okay.
James?
James, did you want to add anything onto that?
I mean, they're good ships. They're the ships we do need, and arguably that sort of 10 to 16,000 TEU sector is where we should have stayed rather than going any bigger than that, where you get the economies of scale, you can get full loadings even in a slightly more depressed market. As I mentioned earlier, the ships they could and would be replacing are getting old. The 5,000 to 8,000 TEU sector is coming up to 30% of that is coming up to 15 years old now, so they will need replacing. But as Evangelos rightly said, you've still got this what I talked about earlier, this paralysis over the new building price, the price parity. I ran a calculation recently on say wide beam Panamax second-hand prices versus new building prices, and there's still a 30% gap there in terms of price parity. So it's a difficult calculation to make sense of now, and also without this partnership which has been lacking for many years between the charterers and the owners. Again, the liner companies have said very publicly they want to become more asset light, but they're still doing a lot of new building, a lot of 23,000s now that the liners are working with at the yards, and we'll have to see whether they come forward and work on these 10 to 12,000 TEU projects and other projects in order to make them viable.
Okay, well, that makes a lot of sense. There are a couple of questions market related. So market fundamentals aside, how does the shipping industry generate public interest in container shipping stocks, or does it not matter? Randy, do you want to take a stab at that one?
Sure. I think the companies similar to this, right, kind of getting the word out and saying, yeah, it's not just Maersk and Costco and Hapag-Lloyd that are making money, right? The container ship owners are also making money now. And I think we'll see that here with the upcoming earnings releases of Danaos and Atlas and Costa Mare and some of these others. That look, it's the strength that we're seeing in the container rates, $4,000 per FEU, from Shanghai to US, is translating to multi-year highs for the time charter market. Everyone on this call probably is aware of that, right? But I'd say general investors probably are not yet, right? And again, what you see in the container rates, 4,000 per FEU, that could fall to 3,000 pretty quickly. Whereas on the time charters for these vessels, if it's, as Evangelos was saying, 30,000 on some of his ships, or even if it's 20,000 on the smaller ones, that doesn't go to 10,000 next month, right? It might go to 18, 17, right, which is very profitable levels. So yeah, I think getting the word out, showing that there is significant strength here, but also, right, it is going to take some longer term kind of sustainability of rates, and also market caps expanding a little bit, being good stewards of the capital, right? Not rushing out and ordering new builds, but making accretive secondhand acquisitions, repurchasing shares like Danaos has done, and we've applauded pretty meaningfully here last week. So I think steps like that will certainly bring investors back to the market and saying, yes, this isn't a massively volatile market such as Capesizes or VLCCs that rates might triple in a month and fall 60% in a month, but it's a little more slow and steady. And right now it seems pretty steady, right? And I say slow and steady. Obviously, the last few months have not been slow by any means, but you should see some steadiness to the rates here for the next few months. And I think that will lead to investors being a little more confident that this market has some legs to it.
Okay. So like a final question. So what is the most logical multiple metric for container ship companies? And what is the logical average level for that multiple to be?
That's the $1 million question,
I'll let,
right?
I'll let the CFO discuss that one.
So you see, I don't think I can give you a multiple because each company is different and there are different considerations. what the quality of the fleet of each company, the quality of the ship management franchise, and all these other things. But what I can tell you is that in the container leasing space, there are many hidden jewels that are being valued way below fair value. And one easy measure to calculate fair value is net asset value, right? And so that's one thing people should look at. And obviously the other thing is, I mean, like our stock, like 6 months ago, was trading at half the earnings of a year. By any PE you want to use, it's not going to be 0.5, right? So all I'm saying is, and this is the story we're trying to articulate, this is an industry which is headed in the right direction. You have companies like ours that, for reasons related to general perception around shipping, were massively undervalued. And I think now the market starts to come around and start seeing these opportunities. We are still a hidden jewel, although people have started discovering it. I hope that we are able, to your previous question, to spread the word as widely as we can, and make investors aware of the investment opportunity in Danaos.
Great.
Well, what if
and
we
so
put
we
it
have
this
one
way,
last.
Evangelos, in terms of, oh, go ahead.
No, Randy, you go.
Oh, I was just going to say, Evangelos, when you're looking at, or James, when you're looking at a secondhand acquisition, what kind of multiple are you putting that on in terms of an EBITDA multiple? Is it 6 times, 8 times, 10 times?
Evangelos?
James?
We haven't looked in the market that recently, so we've consolidated at the moment. So I don't know. And Evangelos has been in the second-hand market more recently than us. We look at the design as well. The design. We look at the physical design of the ship, and then historical averages, and trying to make sure we're making a decent investment on that basis. But maybe Evangelos has got something to add.
We have recently acquired Containerships, and this is public. This is not something which we haven't already shared with the public. We acquired ships in the region of $25 to $26 million acquisition price, chartered them for 2 years at an annual EBITDA of $6.5 million. So basically, you're making, first of all, you're making cash on cash. What is that? 25% on your investment, and then you have scrap being at like 12 million. So you basically acquire a ship, charter it out on a 2-year contract, and 2 years later you've amortized it down to scrap, and you still have a vessel that is 13, 14, 15 years old. So these are pretty good returns. I don't think anyone would disagree, and so multiples at this point are pretty attractive for acquiring second-hand tonnage.
Sure. And I will say this, looking at Danaos, they're trading at, I don't know, 4 times EV/EBITDA this year, and probably less than that next year. So one more question that I just got emailed to me to Danaos. If you want to look at your use of free cash, is it continuing to grow the fleet? Do you look at maybe reinstating the dividend now? Kind of how do you view the priorities here going forward?
Well, we've recently completed a share buyback, which was actually 3 times the amount what we had originally set out to do. We did that because we bought back the stock at very good price levels, and also we did it by acquiring it from 2 large shareholders that were not actively trading the stock. So we managed to buy back something like 18% of the share capital without hurting trading liquidity. And that's significant. This is like half of the free cash flow we are producing for this year, right? So we're producing free cash flow of $50 to $60 million a year, and we want to now again go back to reinvesting in the business, acquiring more ships. I don't think a dividend is going to pop up in the near term. We want to, I think that undertaking a commitment such as a dividend ought to be done at a time when you don't have a pandemic looming over your head, right? So we're going to see how the situation progresses through 2021, and then the board continuously evaluates capital allocation, and at this point, you either buy your stock because it's massively undervalued, or you invest in good assets that generate good returns, and that's what we're going to focus on.
Sure. And the recent share repurchase is probably 5 years worth of dividend payments, so that's fair. John,
All right,
that's it for me.
Randy, unless you have another question, I think that we've gone far over time, and so I want to wrap this up, I think.
Yeah, sorry about that.
All right, fantastic. Well, thank you, gentlemen, for being on this webinar. It has been very, very informative. And this we will post the recording of this webinar to our website later today. So if those that didn't get to see it, you want to watch a replay, feel free to go there to see it. For the audience, thank you so much for tuning in, and we will catch you next time. All right, well, thank you all.
Sounds good. Thank you all. Have a good day.
Thank you.